In this next video segment, we're going to take a look at the construction of total cost, or total fixed cost plus total variable costs. First, let's define what fixed costs are. In a business environment, a fixed cost is any cost that is not related to production. So a cost might include rent, which regardless of whether we produce 1 unit of shoes, 1 pair of shoes, or 1 million pairs of shoes, we still have to pay rent on our production facility or warehouse, unless we own it and then we are making payments on it or accounting for some expense. Maybe we have some admin costs. So the receptionist at the front, the administrative assistant, the salaries for the CEO, the accountant, some managers, human resources. None of these have anything to do with the number of units of shoes being produced and sold. But without these fixed costs, we can't maintain the environment that produces and sells shoes. Maybe utilities that are not associated with production. So this would be the lights in the office, the lights in the parking lot, the energy for the air conditioning in the offices, etc., maybe even in the warehouse, but not the utilities for the equipment that we use to manufacture the shoes. So we might have some utilities that are considered fixed costs. Regardless of whether we're making shoes or not, you're going to keep the lights on. And we might have some utilities that will be considered variable costs, which you'll see in a few moments. Maybe something like health insurance for the administrative workers, liability insurance. Again, these have nothing to do with the number of shoes that we are manufacturing. Maybe our debt servicing. So we have borrowed $1 million to put in place this facility. And whether we're making shoes or not, that debt has to be paid. So we have our monthly payments or our annual payments, we have interest, and this is running whether we're making shoes or not. We might have some equipment expense, which we'll more generally think about as depreciation. And whether we're using the equipment or not, then we are having to somehow depreciate it just because it's becoming obsolete. It's going to be replaced by some more advanced form of innovation at some point, some more advanced form of technology. Obviously, if we are using the equipment, it probably is depreciated more rapidly, but depreciation technically is a function of how we use something, but in terms of accounting, which was really kind of what we're looking at here, is a function of a tax table that is published by the Internal Revenue Service that's agreed upon by legislation and has nothing to do with whether or not we actually use the equipment. And then maybe something like janitorial. So again, fixed costs are those costs that we bear in an operation that have nothing to do with the number of units that we're producing or selling. Well, that would then suggest that variable costs are only those costs that have to do with selling and producing. So maybe we're going to have to think about raw materials. We'll certainly have to think about production labor as opposed to administrative labor. So the CEO, the managers, etc., would be labor that we would have to think about for fixed costs, perhaps. But if we're bringing in workers on a production line to manufacture the shoes, and we're actually running the line and employing them, then those would be production workers. We indicated utilities a few minutes ago, so I'll bring it back on here again. Again, these are the utilities that are associated with running the equipment in the production facility, which might include the lights in that facility, but not the lights or the air conditioning, etc., in the offices. And then we might have some shipping costs. I'm pretty confident that if we're not producing goods, then we're probably not shipping goods either. So let's think of a example of this. So I'm going to say that total cost is equal to total fixed cost plus total variable cost. Fixed cost is equal to total fixed cost plus total variable cost. And I'm indicating here that our rent is $500 per period, I'll say month. Utilities are $75. Administrative salaries, these would be the people in the offices, management, etc., $100. Marketing, which is also going to be a fixed cost in this case at $100. Remember, we're paying for marketing. We're hoping that it will help us sell shoes, in which case we need to produce the shoes, but we don't know that it will, so that's a fixed cost. Once we've paid it, it becomes a sunk cost, if you will. And then we have some of our variable costs, where we have production workers at $10 an hour. We have maybe leather, $2 a pair. Rubber for the soles of the shoes at 90 cents a pair, laces at 15 cents a pair, and then we're selling the shoes at a wholesale price of 20. So we're looking at the fixed cost now and the variable cost based upon our example, and you'll see that in this construction of total cost being equal to total fixed cost plus total variable costs, our fixed costs added up to $775. We had our variable costs, which we have to think about, well, how does that add up? We're going to take the amount per pair that we're looking at, pair of shoes. We had $10 plus 2 plus 90 cents plus 15, which gave us $13.05. And so total variable cost is going to be this average variable cost times the quantity of shoes. If we simply knew the total variable cost, because we, as we're accounting for our environment, if we total everything up and we come up to a number, and then we don't know what the average is yet, we just know the total variable cost, we can find the average variable cost by taking that total variable cost and dividing it by the quantity of shoes, which would give us then the average variable cost. And so you see a total variable cost equation I've given you here. This could be rearranged such that we had total variable cost divided by Q equaled average variable cost. It would be the same equation, of course. So I've given it to you both ways. This then will be fed into an equation of price times quantity being equal to total fixed cost plus average variable cost times quantity, giving us our break-even quantity.